Welcome back. We're going to now talk about preparing a statement of cash flows. Now, this is an important process, step-by-step, how to prepare it. I'm going to go through the long version because I want you to learn it. And then as you're going through the questions, you can take whatever shortcut you want. But if you don't understand it, it's hard to take a shortcut. So, starting out, you'll see here it says preparing a statement of cash flows. Step 1, set up a statement of cash flows in a 3-column format. So chances are a question like this could be a drag or drop, fill in the blank. You may be asked to prepare just the operating, investing, or financing activity section. Back in my day, when I was your age, instead of having 15 minutes per task-based simulation, we had an hour problem. We had 4 one-hour problems. So what that meant was you got a blue book and you would just have to brain dump and prepare a whole statement from cash flows from scratch. And they asked that before. Nowadays, you just need to do sections of it. But I want to kind of walk you through how to set up the statement. Plus, it's great for those in the real world. Everyone's like, oh my gosh, I finally understand what a statement of cash flows is for and what the heck we're doing instead of just being a robot. La, 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 la. CPA, cut, paste, and attach. CPA, certified pain in the CPA, can't pass anything. Anyway, so the point is, just kidding. The point is that we need to learn what the statement of cash flows is, so I'm going to walk you through it. So step 1, set up a 3-column format. I'm going to have debits, credits, change in cash. It says leave ample space. At the bottom of the statement, fill in the amounts for the net increase or decrease in cash and the beginning and ending balances of cash. So we're going to put in there the cash balance because we know the answer, like Jeopardy. The answer is, boom. The question is operating, investing, financing, and how the heck did we get to that number? Step 2, set up a T account for every balance sheet account except cash. So remember how earlier we set up T accounts? We're accounting for not the balance, but the changes. That's what happened during the year. We'll set up our T accounts. Analyze the additional information, preparing journal entries for the transactions, and then post the debits and credits. So we're going to go through the journal entries. They're going to say this happened and this happened and this happened. So all the additional information will set up our journal entries. There's going to be a couple of things that we do. It says begin with net income, put the amount in the increase column in operating activities. For cash flows, if the direct method is used, enter it in the increase column of the supplementary schedule. In either case, indicate that it is net income. In addition, enter the same amount on the credit side for retained earnings. So that if income, right, income would be debit cash, credit retained earnings, or the opposite would be the case. So again, the main thing is that our retained earnings went up, retained earnings went down, and it changed by that balance. So that's one of the things that we're going to look at in order to see what actually happened to the amount. Then it says, for additional entries to the balance sheet account other than cash, go to the T account. So I'm going to do a journal entry here. Couple of rules. If there's a debit or credit to a balance sheet account except cash, where are they? They're in the T accounts. If there's a debit or credit to cash, where does it go? Generally investing or financing. If there's a debit or credit to an income statement account, gain, loss, where does that go? Operating activities. So let's do it again. Entries to the balance sheet account, T account. Debit or credit to cash would go in the appropriate side of the T account or on the schedule, generally investing, financing. Debit or credit to income statement accounts go to operating activities for the statement. Step 4, unreconciled differences on the T account should be eliminated with the offsetting debit or credit going to the appropriate section of your statement of cash flows. And then if the problem calls for the direct method, then you can go back and do that as well. It says direct method, complete the operating activity section of the statement by using the income statement and the related balance sheets. In all cases, complete the statement with subtotals for each section. All right, so that's what we're going to do. I want to apply it now in this class example. So you'll see here, and as I said, you could see a question like this. It could be a drag or drop. It could be a pop-up screen where you click on a box and it pops up either the debits or credits and you have to pick which they are, or it could be a dollar amounts. You have to pick which they are. So that's what you need to think about. All right, let's read this through this question and see what we got. It says the comparative balance sheet for Ruiz Corporation at December 31st, X1 and X0 is as follows. Ruiz Corp, corporate balance sheet, December 31st, X1, X0. All right, so let's start getting our brains kind of going. We start out cash. What is cash? That's the whole statement of cash flows, right? That's my operating activity, starts there and goes through. All right, so that's cash. So we have 550 ending, 430 beginning. What's the change in cash? $120,000. So cash went up by 120, so that's my answer. I've got short-term investments. They went up. What is that? Investments, investing. Accounts receivable affects what? Operating. Inventory, operating. Long-term investments, investments. Plant assets, fixed assets, PP&E, investments. Accumulated depreciation, operating. All right, total assets. Liabilities, accounts payable, operating. Dividends payable, interest received, dividends received, interest paid, operating. Dividends paid, financing, because they go to the owners. Short-term bank debt, borrowed money, financing. Long-term debt, financing. Common stock, $10 par. We'll circle that because we're going to need that later, $10. That's financing. APIC, financing. Retained earnings could be what? Could be operating or it could be financing, right? Because retained earnings could be the change in cash, or it could also be you paid out a dividend, okay? The following additional transactions, so just get our brain going. Net income was $790. Where's that go? That's a cash net income. That would be the indirect method starting point. Where's it closed out into? Retained earnings. So you'd hit the retained earnings T account. A long-term investment was sold for $135. So cash in, investment out. Cash dividends were declared. Dividends are what? Financing. Building costing $600 was sold. Debit cash, credit bond, building. Equipment costing $110 was acquired. Debit equipment, outflow cash. What kind of activity? Investing, right? You're buying a building, buying land, investing. 10,000 shares of stock were issued. Cash, common stock APIC. We learned that in stockholders' equity. What kind of activity? Money came in from issuing stock. What is it? Financing. Prepare a statement of cash flows using the indirect method. Okay, and have a fabulous day. All right, so what are my rules? My rules are, let's first set up the statement of cash flows. So you need a proper heading. Statement of cash flows, Roger Co. for the year end at 12/31/X2 or whatever. Then you're going to have your operating activities. Operating activities. Then I'm going to have a debit, credit, and a delta for change. Then we're going to have, skip a lot, investing activities, and then the same debit, credit, change. Then I'll have financing activities, debit, credit, change. Net increase in cash, which is my answer. Cash went up by how much? 120 plus beginning cash was 430 equals ending cash of 550. Okay? So notice the 120 is the answer. We know the answer. We've got to figure out how much is operating, how much is investing, how much is financing. Is it provided, used, and so on. That's what we need to figure out. We need debits and credits, and debits and credits. So first thing we're going to do is set up your answer schedule. Set this up. You know the answer is 120. These came right off of what? They're full of BS. They came right off your BS, your balance sheet. There you go. Yeah, gotta love it. That's your balance sheet. All right. Second thing we need to do, and let's look at our steps. Step 1, set up a statement of cash flows, 3-column format, put in the cash. Set up a T account for every balance sheet account except what? Except cash. So let's set up a T account for every balance sheet except what? Cash and cash equivalents. All right. So let's skip cash. The next one is what? Investments, short-term investments. So we have investments. Boom, boom. What happened? It went up by $300, so that's a debit. Remember, an asset goes up, it's a debit. An asset goes down, it's a credit. Liability goes up, it's a credit. Liability goes down, it's a debit. Stockholders' equity goes up, it's a credit. Goes down, it's a debit. We should know that, I hope, by this point in the course. Accounts receivable, no change. You know what? I don't know if that's reasonable, but I'm going to put it in anyway because maybe there's a debit that offset a credit and they balance out to 0, but I'll set it up anyway. Next one is inventory, went up by 80. Went up by 80, that would be a debit of 80. My fan's off. Long-term investments, let's see. Long-term investments went down by 100. Credit 100. Next item, plant assets, PP&E. Now PP&E went up by $700, that's a debit. Next one, accumulated depreciation. Now, accumulated depreciation had no change. Is that reasonable? No, because if all your assets are fully depreciated, you may be a going concern doubt, right? I mean, you want to have some kind of depreciation. But maybe we depreciated the exact same amount that we sold and they offset each other. maybe we'll have to look into that. All right, accumulated depreciation. Now, next one is what? Accounts payable. Accounts payable went down by 5, but you know what? Let's put a little squiggly here because now we're looking at the liabilities. So if a liability goes up, it's a credit. If it goes down, it's a debit. This went down, it's a debit. Accounts payable. Next one are dividends payable. And dividends payable went up by 160. We've got short-term debt. Short-term debt went up by, short-term bank debt, 325. We have long-term debt, went up by 110. Then we have common stock, and we just covered that in stockholders' equity and additional paid in capital. Okay, now common stock went up by 100 and APIC by 120. Now, generally in these cash flow questions, journal entry debit cash, credit common stock 100, APIC 120, debit cash 220, right? That's usually what happens, but we'll figure it out later. And then finally, retained earnings. Let's see what happened. Retained earnings went up by 290. Okay, so step 1, set up your answer sheet. Let's run over here. We'll be doing a lot of running, so stay with me. Woo! Step 1, set up your answer sheet. Operating, investing, financing, put in the change in cash plus beginning plus end. You know the ending, boom. So 120, that's our answer. We know it's true. Now, come over here and set up a T account for every balance sheet account except what? Cash and cash equivalents. Okay, so we're going to set up a T account for every balance sheet account except cash and cash equivalents. You want to put, if it's an asset, if it went up, it's a debit. If it went down, it's a credit. Liabilities or equity go up, it's a credit. Goes down, it's a debit. Okay, I put a squiggly here to distinguish between the two. Balance sheets are supposed to what? Balance. Now careful, because if you put something on the wrong side, what do you assume? If this is a debit, I assume I bought equipment, cash went out. If it's a credit, I assume I sold it, cash came in. So it's imperative that you put the debits and credits on the right side. How do you check? Let's check it. Let's do our debits versus our credits. All right? So help me out. Let's do some addition. Ready? 300. I'm doing the debits only. Plus 80, that's 1080, and 5 is 1085. And no more credit, or no more debits, 1085. All right, let's see what we got. Credits, 100, 260, 585, 695, 795, 895. 895, 905, 915, 1115, 1205. What's the difference between 1085? It should be 120, which is cash, because we didn't set up a T account for cash. Shut up, that's good. So let's come on over here, little Michael Jackson. Woo! Notice, this is our T account for cash. There's your 120. Okay, I can handle that. So yes, it balances. What if it didn't balance? What if we were off by some money? Then you could assume if I'm off by 10, maybe this one on the wrong side or something. So if you're off, maybe cut it, divide it in 2, multiply it by 2 to see if one of these numbers went on the wrong side. But your debits and credits should balance other than that balance for cash, so you've got to make sure you do that. So step 1, set up your answer sheet. Step 2, set up a T account for every balance sheet account except cash. Step 3, it says here, analyze the additional information for the transactions, post debits and credits. Begin with net income. What do you do with net income? Your net income was $790. So what does that mean? It means money came in. So right here, I'll start in the indirect method, net income. Debit, $790. Now, where does the offset go? Debit, net income. Credit, retained earnings. That would go over here, $790. Now look, I'm going to need $290, but I've got 7. Chances are I'm going to need a $500 debit. Why would you reduce retained earnings? Why would you debit retained earnings? When you declare a dividend. We'll figure that out later. So step 1, set up your answer sheet. Step 2, set up a T account. Step 3, find net income. Put the offset to retained earnings. Now, step 4, go through the additional information. Set up the journal entries. We're going to set all the journal entries up here. If there's a debit or credit to a balance sheet account except cash, it goes here. If there's a debit or credit to cash, it goes to the statement of cash flows. If there's a debit or credit to income, here's income. We'll reconcile it here in the operating activity section. Unless you know that it goes somewhere else, but generally it's here. Step 1, step 2, step 3. Pretty easy. Let's do it. All right, first bullet, net income was $790. We just did that, right? Debit cash, boom, credit, retained earnings over there. Next item. A long-term investment was sold for $135. There were no other transactions affecting long-term investments. All investments are classified as available for sale. So, look at the investment T account. The investment T account, it says long-term investment. On your balance sheet was $100 change. So I'm going to debit cash because it was sold for $135. I'm going to credit long-term investment for $100, and I'm going to have a gain of $35. Okay, so what we need to do is say, okay, well, what happened here? What happened here is we sold this long-term investment and we must have gotten some cash. So what are the rules? Debit or credit to a balance sheet account except cash, that's this, goes over here. So I'm looking for a credit of 100. I found a credit of 100. I'm done with the T account. It's not the balance. What is it? Changes in pay. It's a change. Okay? Second rule, debit or credit to cash. What caused this transaction? A sale of an investment. What kind of activity? Investing. So where does this cash go? Under investing. So I'm just going to call it here, proceeds, sale, long-term investment. And it's a debit, inflow, 135. So I just found 790 of the 120, 135 of the 120. Those are both debits, inflows. What's this next item? Debit or credit to an income statement account goes up here. So I'm going to call it gain on sale of investment. Now I'm crediting 35. Let's think about it. Here's 790. Why am I backing out 35? Anybody? Why? Well, how much did this investment cost me? It cost me $100 and I made $35 gain. Isn't the $35 gain already included in this number? Isn't the $35 gain already included in that number from the income statement? Didn't I just double count the gain? Yes, so you better back it out. One more time. This number is net income. Bottom line of the income statement, which includes a $35 gain. This cash proceeds is $135. It includes $100 cost in, cost out, plus a $35 gain. So the gain's already in here and the gain's already in here. I've double counted. Back it out. Makes sense. Yeah, okay. All right, let's go on to the next bullet. It says cash dividends of $500 were declared. We learned this in stockholders' equity. Journal entry, debit retained earnings, and it was how much? 500. Credit dividends payable. Okay, so what kind of account is dividends payable? Balance sheet account. What kind of account is retained earnings? Balance sheet account. So let's come over and look for them. Looking for retained earnings, debit 500, this minus this, done. Dividends payable, here it is. I just did what? I just credited it for 500. Now, I only want it to go up by 160. That means I'm going to need a debit later. What do you think is going to happen during the year? If they don't tell me, you'll have to figure it out. Chances are I must have paid off the dividend, at least 340 bucks of it. But we'll figure that out in a minute. Next bullet. Building costing $600 and having a carrying amount of $350 was sold for $350. So a building costing $600. So we're going to get rid of PP&E. We're going to debit cash. We're going to debit accumulated depreciation. And we're going to have a gain or a loss. Make sense? Okay, so let's read it carefully. A building costing $600, having a carrying amount of $350 was sold for $350. So how much cash? $350. What is the book value? Book value is cost net of accumulated depreciation. So they're telling me that which number goes where. Let's see. Are they saying that I should put $350 here? It says the book value, carrying amount was $350. That goes here. My carrying value is $350. That means that this must be $250. That's 6 and 6. That means 0 gain, 0. Oh, so here's the trick. If you would have put the $350 here, you would have thought you had a big gain. $100. But they said the book value or carrying value is $350. That means cost net of accumulated depreciation is this. That's the number you plug. Okay, so journal entries, debit or credit to a balance sheet account, PP&E, and accumulated. So PP&E, it's a credit here, it's a credit here. So I'm looking for a net debit. Wow, I'm going to have to buy a lot more later. Accumulated depreciation is a debit. Wait a sec, I thought there was no change. So guess what? If they don't tell you anything, I bet debit depreciation expense, credit accumulated, that's what's missing. But we'll figure it out. What's the other thing? Got that, done, got that, done. Oh, debit or credit to cash. You know the rules. What kind of activity is the purchase or sale of equipment? It is a what? Investing activity. So let's come over here. What do we call it? We'll say proceeds sale of PP&E, inflow 350. All right, because that's an investing activity. All right, next item. Equipment costing $110 was acquired through the issuance of a long-term debt. So we got equipment, $110, PP&E. Credit long-term debt, $110. Notice, did I touch the word cash? No. What kind of activity is this? Non-cash. Where does it go? Supplementary schedule. But you still have to cross out the accounts. So I'm looking for equipment. Here's a debit of $110, PP&E, property, plant, equipment. Over here, I've got, here's long-term debt, $110. I'm done with that. So as I finish off the T accounts, I cross them out so I know I'm done with them. All right, next item. 10,000 shares of common stock were issued at $22 a share. All right, this shouldn't be bad. So debit cash, credit common stock, additional paid-in capital from common. We learned that in stockholders' equity, but they're probably not asking that you distinguish between APIC common, APIC preferred, APIC treasury, and so on. So credit common stock always for how much? Par. So 10,000 shares at $10 par. How do I know 10? Look at the balance sheet. Common stock, $10 par. That's 100,000. APIC is the difference of 10 and 22, which is 12 times 10,000 is 120, and this is 220. Remember, as I said, generally common stock APIC over here, common stock 100, looking for 100, bye. Looking for 120, bye. Gone. Now, what kind of activity is the issuance of stock? That would be a way to get money into the company. We call that a financing activity. So we got 220 in. I'll say proceeds issuance of common stock. How much? Debit 220. All right. So, whoops, that's it for the items. So what are the rules? Step 1, set up your statement of cash flows. Find net income. Put the offset to retained earnings. Step 2, set up a T account for every balance sheet account except what? Except cash and cash equivalents. Set up a T account for every balance sheet account except cash, cash equivalents. Add them up, make sure the debits and credits are on the right side. Step 3, come to the additional information, do the journal entries. 3 rules. Debit or credit to a balance sheet account, go to the T account. Debit or credit to an income statement account goes over here on the income. Debit or credit to cash goes on the statement of cash flows. Perfect. All right, so we just did all that. Now let's look back and see what we do. What's the next step? Any unreconciled differences, step 4, in the T account balance sheet, T account should be eliminated with the offsetting debit or credit going to the appropriate section of the statement of cash flows. So it should go to the proper section of the statement of cash flows. Okay, so that's what we need to do is figure out where on the statement of cash flows it goes. All right, and that's what we're going to have to look at. So, what's still open? All right, investment went up by 300. Now, here's the deal. They didn't tell me what happened here. So, to close it out, what do I need? Basically, to get an X like this, I need a number above it. So, since they didn't tell me what happened, you have to create it. So, let's assume we debited investment by 300. What happened? Well, they didn't tell me. Assume you spent cash. Okay, but we won't just say cash, 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 because everything on the statement of cash flows is cash. So what we'll say is increase in investment, and that's an outflow. So let's come back over here, and we're going to say increase, or let's say not increase, let's say acquisition of investment, or increase in investment outflow credit 300 bucks. So that's all we're going to do. The next thing, AR had no change. We'll just assume that's right. The next one is inventory went up. If it's a debit here, it's a credit there. Inventory went up, you must have done what? Spent money. So that's an outflow. It's a debit here, it's a credit to cash. So what are we going to call it over here? Acquisition of inventory, and it goes into operating. Because you know, acquisition of inventory, you know that acquiring inventory is what? Oops, I erased this by accident. Gain on sale, what was that? 35. Acquisition of inventory is what? Is an outflow of money. So in this case, I must have spent 80 bucks cash. Why? Because you know part of this cost of goods sold wasn't paid for. Boom, 80. Inventory went up. I must have spent money. All right, coming back over here, gone. What do I need here? PP&E. I need a big number here. 6 and 7 is 13 minus 11. 13 minus 1 is 12, minus 100 is 1190. So I need debit, PP&E, credit cash. But we don't call it cash, we'll say acquisition of PP&E. That's an outflow, 1190. So back here, we know it's an investing activity. Acquisition of PP&E, you're investing in yourself, 1190. Beautiful. Next one, done. Here we go. You know what? They didn't tell me. Why would you credit accumulated? Well, probably because you debit depreciation expense. Now, it's a credit here, it's a debit over here. Now, what kind of activity is depreciation expense? Depreciation expense would go up in operating, and it's a debit. Anybody, why am I adding back 250? Because I started with net income. On the income statement, this was a reduction. Guess what? Wasn't a cash outflow. I still have the money. Add it back. Like that. Next item. Accounts payable, 5. So it's a 5. I need a debit here. It's a credit there. Payables, you know, is from operating. So it's a payables went down. So it's a debit there. It's a credit here. Decrease in AP. All right, why am I crediting decrease at AP? Why am I hitting that for 5? I don't know, but it works, right? Just kidding. So what do we do? If it's a credit there, it's a debit here. If it's a debit here, it's a credit here. So payables went down. Guess what? That means that I paid off everything I bought plus last year's payables of $5. So I have $5 less than I think on my income statement. Back it out. $5 sub sandwiches. Right? Isn't that commercial? $5. Anyway, so take it out. Next item. Oh, here it is. I got dividends payable. Boom. I must have 340. 500 minus 340 is 160. Debit dividends payable. Credit what? Cash. So what is this? Payment of dividends to shareholders. What kind of activity is that when you pay a dividend? It is a cost to the owners. It is financing activities. So payment of dividends. Outflow what? Outflow 340. Beautiful. Next item, so we're done with that one. Here we go, short-term debt. So credit, 325. I must debit cash. So short-term debt, that means I must have borrowed money. Money must come into the company. So proceeds from short-term debt. And that's going to be an inflow of 325. Very nice. Coming back over here, let's see. We're done. Everything's done. Let's review. Step 1, set up your answer sheet. Step 2, set up a T account for every balance sheet account except cash. Then add them together, make sure they look right. Step 3, find net income. Put the offset to retained earnings, which we did here, net income. Step 4, go through all the journal entries. Recreate all the journal entries, put them here. 3 rules. Debit or credit to a balance sheet account except cash, T account. Debit or credit to cash, statement of cash flows. Debit or credit to income, operating activities. All right. Step 5, whatever's left, what do? Go back and close everything on the balance sheet because you've got to account for all the changes on the balance sheet. That's what we just did. Then step 6 basically says add it all up and have a cocktail. Cocktails. All right. So we've got 790, 35, 80, 255. I've got debits of 1040, credits of 120, which gives me 920 positive. What do I call that? Net cash provided by operating activities, 920. I've got 135, 350, 485. Here I've got 1190 and 3, which is 1490. Difference is 1005 negative. What is this called? Net cash used by investing activities. Next one, I got 220 and 325, 545. I've got 340, 340. Difference is 205. So 920 minus 1005 plus 205 better be 120, which we knew 31 minutes ago. Okay? So 30 minutes ago, we knew this was 120. All we had to do is figure out how the heck to get here. Notice this is operating activities, investing activities, financing activities, and the answer. You'll see the solution in your notes in a much more legible format. And I love to impress upon my students, guess what? I have the worst penmanship known to mankind. And guess what? They still passed me. And this was when it wasn't computerized. They had to read my scratch notes. They had to read my blue book. Guess what? If I could get through the exam with this ugly, scary writing, you can get through the exam. But you need to master a question like this. So what I want to make sure you do is you go through this question again and you practice this question, because I want to be reasonably assured that you understand the concepts and that you can get through the question. You'll also see that I included some questions in the class questions so you could practice with those, because it's really important that you practice with those questions, that you understand the multiple choice, but you also understand the simulations as well. Okay? Very important. In a minute, we'll talk about this under IFRS.